It's early morning here on January 27th, 2026, and I need to talk about what happened last night on the COMEX tape. Because if you were watching the silver market at around 11:45 p.m. Eastern, you witnessed something that most people are going to completely misunderstand when they wake up this morning. Silver hit $117.19 per ounce, and then it just stopped. The circuit breakers kicked in, limit up freezes across multiple exchanges, and when trading resumed, we gapped down $7 in what felt like seconds. The media is already spinning this as a retail bubble, another GameStop situation, telling everyone the crash to $30 is inevitable because there's plenty of silver in the ground. But here's the thing. I've been trading commodities for over a decade, and I've learned to ignore the screen when the real story is happening somewhere else entirely. And right now, the real war isn't on the price chart. It's in the lease rates. I'm not here to sell you a course or pump my book. I started using this AI avatar format because it lets me get information to you faster than I ever could recording traditional videos. The landscape has become polluted with channels using AI to churn out garbage analysis. And frankly, I got tired of watching retail investors get fed bad intel while institutional players were already positioned 12 hours ahead. I have access to Bloomberg terminals, vault reports, primary data sources that most individual investors will never see. And what I'm seeing right now in the silver market is something I haven't witnessed in my entire career. So let me be very clear about what I'm going to lay out for you today. Silver has fundamentally transformed from a precious luxury into a critical industrial necessity. And while we're absolutely going to see some technical cooling off in the short term, this rally is overextended by every measure. The era of cheap silver is over. We're looking at a permanent structural floor near $100 per ounce, and I'm going to show you exactly why. By the end of this video, you're going to understand three things. First, why the Shanghai-London arbitrage spread is the smoking gun that proves this isn't speculative froth. Second, how the lease rate trap is strangling the institutional shorts in a way that could trigger a force majeure event. And third, I'm going to walk you through the math on the 800 million ounce deficit that nobody in the mainstream media wants to acknowledge. Then I'll share my personal battle plan for the next 6 weeks, because I'm not selling a single ounce of my physical position, and I'm going to explain exactly why. Let me give you the current snapshot as of this morning. Spot silver is trading at $110.52. The volatility is absolutely insane. We're seeing intraday swings that would have been considered monthly ranges just 2 years ago. The dollar index is sitting at 97.04, which means the traditional headwind for precious metals is completely gone. The dollar is bleeding, and that's removing one of the major structural barriers that kept silver suppressed for years. The gold to silver ratio has collapsed to 46 to 1. Gold is over $5,000 per ounce, but silver is moving 3 times faster. Think about that for a second. For decades, that ratio sat between 60 and 80 to 1. The fact that we've broken through 50 tells you something fundamental has shifted in how the market values these metals. But here's where it gets interesting, and this is where you need to stop looking at the price and start looking at the structure. The COMEX registered stocks, the physical metal that's actually available for delivery, are down 70% since the 2020 lockdowns. 70%. Meanwhile, the Shanghai premium for physical silver is running at $10 per ounce over London spot. Let me repeat that. If you want physical silver delivered in China today, you're paying $10 more than the paper price in London. I want you to look at the vertical line of price action over the last 52 weeks. We're up 223%. Now look at the flat line of global mine production. It hasn't moved. If silver was actually plentiful, if the supply was there to meet this demand, why would China be paying a $10 premium just to get metal today instead of waiting for a futures contract to settle? The answer is simple, and it's the same answer that explains everything else that's happening right now. The metal doesn't exist where the market needs it. And that brings me to the mechanism that most people don't understand, the one that is going to determine whether we see $150 or a complete market failure. Let's pull this apart. I need you to understand what silver lease rates actually are, because this is the tripwire that turns a normal bull market into something much more dangerous. Silver lease rates are the interest rates paid to borrow physical metal. When you hear about banks shorting silver, they're not just selling paper contracts, they're borrowing actual physical metal from vaults, selling it into the market, and hoping to buy it back cheaper later to return to the vault. The lease rate is what they pay for that privilege. Now, backwardation is when the spot price, the price to have the metal right now, is higher than the futures price 6 months out. In a normal market, that doesn't happen. Normally, the futures price is higher because you're paying for storage, insurance, the time value of money. But when backwardation shows up, it means the market is screaming, "We need this metal today, not in 6 months." Think of it like this. Imagine you're at a tiny airport during a holiday weekend and every rental car is booked. If a daily rental costs $500 but a monthly lease is only $1,000, you know instantly there isn't a single car left on the lot. The spot market is in panic mode. That's what's happening in silver right now. The lease rates are at record highs, and the curve is inverted. The market is willing to pay a premium for immediate delivery because waiting isn't an option. And here's why that matters more than the price chart. Record high lease rates prove this isn't paper speculation from retail traders on Reddit. This is physical panic from industrial users who literally cannot run their factories without silver. When lease rates spike like this, it forces the institutional shorts, the banks who sold metal they don't have, into an impossible corner. They can't borrow metal to cover their positions because there's no metal available to borrow at any reasonable rate. That's the trap. And once you're in that trap, the only way out is to buy at market, which drives the price even higher, which makes the trap even tighter. This is the mechanism that turns a rally into a force majeure event. And the numbers behind this trap are even more terrifying than the price. Let me run the math for you. And I'm going to use conservative assumptions because I don't need to exaggerate to make this point. Even if industrial demand drops by 20%, which would require a major global recession, and mass substitution away from silver in solar panels, electronics, and EVs, we're still facing a 150 million ounce deficit for 2026. This is the 6th consecutive year of deficits. Not 1 year, not 2 years. 6 years of structural drainage. The cumulative deficit since 2021 is somewhere around 800 million ounces. That's 800 million ounces of above-ground inventory that has been consumed and is not coming back. There is no buffer left. The vaults are not full of secret stockpiles waiting to flood the market. I've seen the reports. The registered inventory at COMEX, the London vaults, the ETF holdings, they're all declining or flat while demand continues to accelerate. Now let me stress test this with a scenario that keeps me up at night. There's an unverified rumor circulating in institutional circles about Saudi Arabia potentially rotating a portion of their treasury reserves into physical commodities, including silver. I can't confirm that rumor, and I'm not going to present it as fact. But let's say it's even 10% true. Or let us say Tesla's direct-from-mine supply contracts, which they've been quietly negotiating to secure silver for their battery production, fall through because the mines can't deliver the volume they promised. If either of those scenarios plays out, we're not looking at $120. We're looking at a total market failure where silver stops having a functional price because nobody who holds physical metal is willing to sell at any number the market can offer. That sounds extreme, I know. But I need you to understand that we've already seen smaller versions of this in other commodities. Remember the nickel squeeze on the London Metal Exchange in 2022? They literally canceled trades and shut down the market to protect the shorts. It can happen. So let me recap where we are. We have a physical drain evidenced by the Shanghai premium. We have a borrowing crisis evidenced by record lease rates and backwardation. And we have a math problem that doesn't add up unless you believe demand is going to collapse or supply is going to magically appear. Neither of those things is happening. Now, I know what the skeptics are going to say, because I've already seen it all over financial Twitter this morning. They're saying, at $110, the solar industry will just switch to copper. Demand will vanish, and silver will crash back to 30. Let me address that directly, because it's the most common counterargument, and it's based on a fundamental misunderstanding of how supply chains work. You cannot rewire a global industrial supply chain over a weekend. Copper plating solar cells is not a plug-and-play substitution. It requires retooling factories, re-engineering cell designs, recertifying products for safety and efficiency standards, and accepting massive warranty and reliability risks. The solar manufacturers I've spoken with estimate it would take 3 to 5 years to scale copper-based alternatives to the point where they could meaningfully reduce silver demand. 3 to 5 years. We don't have that kind of time, and the price isn't going to wait. The other myth I keep hearing is that high prices will bring out scrap supply and flood the market. Here's the reality. Grandma's silverware and jewelry were already sold when silver hit $30 and $50. By the time we crossed $100, the easy scrap, the stuff sitting in attics and pawn shops, is already gone. What's left is either industrial scrap, which is already being recycled efficiently, or heirloom pieces that people aren't going to part with regardless of price. And even if scrap supply doubles from current levels, it's not enough to close a 150 million ounce annual deficit. The math doesn't work. I've run the numbers every way I can think of, and there's no scenario where scrap alone saves the market. Here's the part that really frustrates me when I hear the high prices will fix this argument. It takes 7 to 10 years to bring a new silver mine online. From exploration to permitting to construction to first production, you're looking at a decade minimum. Price cannot create supply in 2026 or 2027 or probably even 2030. The supply response is structural and slow, while the demand shock is immediate and massive. So if the supply isn't coming and demand isn't collapsing, the only question left is, who blinks first? Who is forced to cover their short position or secure physical supply at any price? And what happens to the market when they do? Let me tell you what I think happens next. And this is based on watching how exchanges behave when they're trying to protect institutional players from getting steamrolled. Watch for the CME to hike margin requirements. They've already done it twice in the last month, and I expect at least one more round of increases in the next 2 weeks. The goal is simple: shake out the leveraged retail traders, trigger forced liquidations, and create a temporary price dip that gives the big banks some breathing room to cover their short positions without causing a full-blown squeeze. It's going to work, at least partially. We're going to see volatility that will scare a lot of people out of their positions. But here's what the margin hikes can't fix. They can't fix the physical shortage. They can manipulate the paper price temporarily, but they can't create metal that doesn't exist. So here's my dashboard for the next few weeks. I'm watching two things very closely. First, the Shanghai premium. If that premium drops below $2 per ounce, it tells me the immediate east to west physical drain is slowing down. That would be a sign that China's demand is satisfied for now, and it would reduce the pressure on the vaults. As long as that premium stays elevated, especially above $10, I know the physical panic is still active. Second, I'm watching the lease rates. If lease rates stay elevated even while the price dips, that tells me the squeeze is still on. The shorts are still trapped and any price weakness is temporary. But if lease rates start to normalize while the price is falling, that's a different story. That could indicate the physical tightness is easing, and we might see a more significant correction. We're entering what I'm calling the volatility zone. $10 swings in a single hour are going to become the new normal. If you're not prepared for that psychologically, if you're trading on margin or using options, you're going to get destroyed. This is not a market for the faint of heart right now. Let me tell you exactly what I'm doing with my own money, because I think it's important that you understand. I'm not just analyzing this from the sidelines. I have skin in the game, and my decisions reflect the conviction behind everything I've just laid out. I'm staring at the $97.86 support level. That's the line in the sand for me. If we get a panic flush down to $97, which I think is possible if the CME hikes margins aggressively, I'm deploying my remaining cash reserve into physical 10-ounce bars. Not paper, not ETFs, not futures. Physical metal. I view $100 as the new psychological floor, and any dip below that is a gift. If the Shanghai premium stays above $10 per ounce, I'm not selling a single grain of what I already hold. The East knows something we don't, or they're seeing something in their supply chains that hasn't made it into Western data yet. When Chinese buyers are willing to pay that kind of premium, I'm listening. But if the CME hikes margins by more than 50% in a single week, I'm sitting on my hands. I will not add to positions while forced liquidations are happening. That's a rigged game, and I'm not interested in trying to catch a falling knife while the exchange is actively manipulating the tape to protect the banks. I'll wait for the dust to settle, reassess the physical indicators, and then decide. Here's my broader perspective, and this is important. I'm not playing for the next 48 hours. I'm not trying to catch the top of this move or trade the volatility. I'm positioning for the 2027 and 2028 industrial demand peak. The solar build-out, the EV transition, the grid infrastructure upgrades, all of that is still coming. The structural deficit isn't going away. So whether silver tops out at 120 or 150 or pulls back to 95 first, I don't really care. My time horizon is 2 to 3 years, and I believe we're in the early innings of a decade-long revaluation of this metal. Let me bring this all together. The $100 breakout is real. It's not speculative froth or Reddit-driven pump. The physical vaults are empty, lease rates are screaming scarcity, and the math on the supply-demand deficit doesn't lie. We've had 6 consecutive years of structural drainage, and there's no cavalry coming to rescue the shorts. Could we see a sharp correction from here? Absolutely. In fact, I'd be shocked if we don't. The technical indicators are stretched, sentiment is frothy, and the CME is going to do everything in their power to engineer a shakeout. But a correction back to $90 or $95 doesn't change the fundamental story. It just gives people like me another chance to add physical at a discount. This is no longer a trade. It's a global revaluation of a strategic industrial asset. Silver has gone from being a monetary relic to being essential infrastructure for the energy transition. And the market is only just beginning to price that in. The next 12 months are going to be absolutely wild, and I genuinely believe we're going to look back at $110 as cheap. So here's what I want you to do. Don't panic when the volatility hits. Don't let margin calls or exchange manipulation shake you out of a position you believe in for structural reasons. And for the love of everything, don't listen to the talking heads on cable news who are still calling this a bubble without understanding the first thing about lease rates or Shanghai premiums or the cumulative deficit. If you want to understand the next phase of this move, specifically how the new Chinese export licenses are about to choke the LBMA even further, I've got a deep dive coming on what I'm calling the Great Chinese Silver Break. That's going to cover the regulatory angle that most people are completely missing right now. But for now, I hope this gave you the framework you needed to navigate whatever comes next. Stay sharp. Keep your eyes on the physical indicators, not just the price. And remember, the real game is being played in the vaults, not on the charts. I'll see you in the next one.